Welcome everybody to a video about the Pass-Through Entity Tax Credit. I'm Stephen Morris with Advisory, and I'm here to give you the lowdown on what the Pass-Through Entity Tax Credit is all about. Let's begin with a discussion about why the Pass-Through Entity Tax Credit was passed in California. Back in 2017, the Tax Cuts and Jobs Act was passed by the Trump administration. And the main feature of that, besides the numerous other tax changes to the code, was the itemized deductions. In fact, prior to 2018, you were able to deduct in high tax states like California and New York, all of your state income taxes, as well as all of your property taxes. And these deductions would amount to quite a significant amount of money, considering that, the top rate in California is 13.3%. If you're making over $1 million a year, that can very quickly add up to hundreds of thousands of dollars. And all of this was fully deductible under the code prior to 2018. In addition to that, if you owned a home in California, your property taxes were deductible as well. And so you own a home for, let's say it's a $2 million home, that might work out to be something like a $22,000 or $23,000 a year tax bill, depending on where you are and what the millage rates are in that particular area. So with that in mind, most Californians prior to 2018 were able to take all their state income taxes and all of their property taxes together, and they were able to take one deduction for all that amount. What subsequently happened was when the Tax Cuts and Jobs Act of 2017 was passed, they limited all of the taxes to $10,000 per year. You take all of your state income taxes, all your property taxes, $80,000 was paid that year in state income taxes. $20,000 was paid in property taxes, the combination of which is $100,000. They would say, that's nice, we're gonna limit you to $10,000, which massively hurt people in California, New York, and other high tax states. So in response to the fact that Californians were just completely upset that their deductions were pretty much reduced to nothing, the state of California decided to pass a law which allowed an elective tax to happen. And this would happen at the entity level instead of the individual level. And conceptually, the way it works is the owners of an entity can opt in to pay this tax, which I know sounds crazy at first, but bear with me. I'll show you why it's just such a tremendous tax advantage. Once they make this election, then the entity can go ahead and pay this tax, and the tax will then translate as a credit to those owners of the pass-through entity, pretty much dollar for dollar. And again, there are some limitations which we will go into, but basically that's it. Now you can change the level of the tax to the entity level, and it becomes fully deductible. So let's talk about the concept of what is a pass-through entity. Pass-through entities are things like entities that are taxed as a partnership or as an S corp. This could be an LLC, taxed as a partnership. It can be a single member LLC. It can be a LLC taxed as an S corporation, or it could be a corp taxed as an S corporation. What it may not be, however, is a corporation taxed as a C corporation under code section, the 300 series of the Internal Revenue Code. To give you just a high-level understanding of the way pass-through entities work, pass-through entities are not taxable at the federal level. So if you have a partnership, for example, or an S corporation, the federal government's not going to take any tax out at that level. What happens instead is all the income and expenses, or the net of those amounts, flows through to the owners, and then the owners are then taxed at their own perspective tax rates, their own marginal tax rates. So for example, if a bakery, and so you have two bakers who are partners and they own 50-50 of the company, and the company at the end of the year has a taxable income of $100,000, they would allocate $50,000 of taxable income to Baker 1 and $50,000 of taxable income to Baker 2. So under the new pass-through entity tax rules, what these two bakers can do, for example, is elect to pay this tax. And so they can both sign it and say, we both elect to opt into this tax. Not all of them have to. If Baker 1 says, hey, this isn't going to be a good tax outcome for me, he can elect out. Baker 2 is more than able to go ahead and calculate a pass-through entity tax credit as it relates to his proportionate share of the partnership, and the partnership will then pay taxes on his behalf. So when the partnership decides to make this election, they will do so and pay 9.3% of the taxable income for the partners. So let's assume in this case that both bakers decided to go ahead and make this election. And so $100,000 is the taxable income. They would pay 9.3%, that's the percentage set by the law, into the state of California. And the partnership would then take a deduction for that tax paid of $9,300, which is 9.3% of $100,000. So the impact of taking that election after a $9,300 deduction would result in the partnership having a taxable income of $90,700, which would then be split 50-50 between the partners. Simultaneously, that $9,300 that they paid into the state of California flows through to the partners as a credit. So it's a dollar-for-dollar tax reduction that'll be realized when they file their own income tax returns at the individual level. Since the partnership was able to realize a deduction of $9,300, we then calculate what the tax benefit would be at the federal level. Since California will not give you a tax benefit as a deduction at the state level, they'll only give you a credit for your payments, and we'll go into the mechanics of that over the next few examples. But in any event, if we assume that we're going to use the top marginal tax bracket rate of 37%, then the amount of tax saved at the federal level from paying this $9,300 in taxes as a pass-through entity tax credit would work out to be $3,441 of federal tax savings. And by the way, they were going to make this $9,300 payment, maybe even more, anyway on their individual tax returns, because they would have to pay that on their own respective tax returns. So let's talk through some of the mechanics on how to take advantage of this tax return. There are a few compliance issues that we have to knock off of our list in order to ensure that this credit is available to you in the future and any of your future tax returns. Number one, I want you guys to write down June 15th. That date is extremely important. Not only is it the date that quarterly estimates are due for both California and for the federal, but on top of that, that's the date that you have to pay in some amount of money to the state of California in order to realize the credit. And so the way it works is this. One, if you didn't take advantage of the pass-through entity tax credit in the prior year, you need to pay $1,000 by June 15th. That gives you the opt-in to take the election to go ahead and take advantage of the tax credit. If you did take it in the previous year, what you're going to end up doing is paying 50% of whatever you paid last year towards your credit on June 15th as well. Now you can always opt out at the end of the year and you can decide you don't want to do the tax credit, but you must pay it by June 15th if you want to opt in. If you don't, you blow your election, you're going to have to wait till the next year in order to realize the advantage of the tax credit. Now on the partnership or the S-Corp return, you're going to be filling out a form called 3804. And maybe it's not going to be you, it might be your tax preparer, us perhaps. And so what we're going to do is include that form along with a calculation of qualified net income, which I will go into in the FAQ, and we will multiply it times 9.3%. That will calculate the amount of the credit that the entity must pay. And then there'll be an allocation based on the pro rata share of the partnership by member. And you'll see that scheduled out here, which now if you can take a look at the slides, you will see the pass-through entity elective tax calculation form 3804. So the 3804 relates to the filing that the entity is going to take. So it's going to be your S-Corp, it's going to be your partnership, it's going to be your LLC taxed. And on the individual tax return, so on the California return, you're going to be filing form 540. 540 will have numerous amounts of attachments, one of which will be 3804-CR. And what this form does is it schedules out all the credits that you're receiving from all of your pass-through entities and the calculation, the identification number, which will then flow through as a dollar-for-dollar reduction of your tax liability on your California tax return. This does not impact the taxes paid at the federal level. Keep that in mind. So lastly, let's talk about some reasons why you'll want to take the pass-through entity tax credit and maybe some reasons why you may want to consider opting out. So the reasons for taking it are pretty clear. You get a tax deduction for paying taxes that you normally would pay on the individual level anyway. It's just that the form of those payments just happens to come from the business, which under the code is considered to be an ordinary necessary business expense. The reason why you may not want to take the tax credit, first is your taxable income might be in California so low that it might be under the 9.3% threshold. If that's the case, you're going to have a tough time using up the entirety of the credit. It doesn't necessarily mean that you shouldn't take it, because the impact of the tax deduction at the federal level may potentially offset some of the credits that you're going to lose on the California side, but that's a calculation you're going to have to discuss with your tax professional. Simultaneously, there is an interplay with other credits, which is going to be a little bit beyond the scope of this video, but primarily if you are taxed in multiple states and you are paying in state taxes to those states, you would get something in California called an other state tax credit, which is filled out in Schedule S of the tax return. Because of the way ordering works out, it's possible that the interplay between other state tax credits and the pass-through entity tax credit may actually eat up some of your credits and reduce the incentive to actually make this election and pay in. That's another complex calculation that we would have to explore with you when that time comes. So in short, I hope this short little video helps you understand a little bit more about the pass-through entity tax credit and all the wonderful benefits that it offers. This credit's not going to be around forever. It's due to sunset at the end of 2026, which is around the same time as the Tax Cuts and Jobs Act is set to expire. And so the thinking there is that if TCJA is sunsets, then there's no need for this credit any longer. But in the meantime, I highly encourage you to look at this. Even if you're not our clients, you should go ahead and ask your tax preparers to understand and assess whether or not this particular credit is to your advantage. Please let me know if you have any questions. You can email us at the link over here, and we hope to see you soon at the next video.